Let's keep talking some big tech and the mega caps that have been doing pretty well. Amazon did take a hit in the last few weeks, but had a great year to date and has earnings coming up. Let's trade it and talk about how to invest in the sector with Nick Griebenow joining us from Shelton Capital. He's a portfolio manager of the $500 million Shelton Equity Income Fund. And you've got a pretty unique approach, I think, both holding the stocks, then also trying to generate some income. Nick, how does Amazon fit into that strategy right now?
Absolutely. Thanks, Oliver. Thanks for having me today.
Thank you.
Amazon certainly fits in, with any of the large cap funds. You'd expect that they're going to have positions in some of these big FANG names, the Magnificent Seven, and how well they've done so far this year. So especially with them coming into earnings next week, next Thursday, they'll be coming out after the bell. That short-term volatility is elevated. That's something to look to take advantage of in the options trading space. You're going to get a lot more attractive premiums on a short duration basis and really be able to get some attractive annualized cash flow by taking advantage of that short-term IV influx that you get around an earnings release.
Okay, so I guess since you own the shares in the fund, this is the approach you're using for EQTIX. I guess you wouldn't be selling puts then? You're selling calls since you already got the long position in there? Or what's the approach?
That's correct. Yep, that's correct. We own the stock and not necessarily with Amazon, but with all of our other holdings. A big piece of that is we're looking for that potential for capital appreciation as well as, on dividend payers looking to harvest that dividend yield as well. So primarily looking at selling covered calls, not really on the put side of things at this point.
Okay. How do you figure out what strikes? Is it discretionary? Do you guys have an algo, like a set it and forget it type of thing? Or is this just your eyeballing the options based on where volatility is going into the event?
So we have a number of criteria that we look at as far as picking the strike. We want to get at least 1% of the underlying stock's price and cash flow. So with a name like Amazon, trading around 125, we need at least $1.25 to entice us into that trade. Beyond that, we're going to be looking at the cash flow and how it annualizes on a duration basis, as well as, we want to leave some room for capital appreciation. We don't want to go out here and write at the money contracts. So, in an earnings season, we're able to sell very short duration options, get well out of the money, leave some potential for upside in the underlying stock. When there's not an earnings release coming up, we might go a little farther out, be writing 60-day duration options to give ourselves a little more out of the money room in case we do see an uptick in the underlying.
Okay. Now, can you do this for all of the major holdings, or does it really depend on how the options market is setting up? I mean, is this the approach for every piece of the fund, or do you only do this for certain companies at certain times?
So we do sell calls against pretty much every position in the fund. We don't typically go out and fully cover every position. Usually we have about 30 to 35% of the underlying shares with calls written against them. But especially with how much option volume has been picking up, S&P 500 names in general are going to have pretty liquid options chains. I was looking earlier today, and there's been a lot of zero date expiration trading on SPY. There's 4 strikes of contracts that expire today that have had over 1 million contracts in volume today. So with the increase in options trading activity, liquidity and options market viability is not much of a concern. So we're looking to write against pretty much all of the holdings, and the coverage level, duration, how far out of the money we get, that is going to be dependent on a security basis. But, we write covered calls here.
Okay. And the risk then is that the market just totally rips to the upside. You'd underperform then. I would guess that if the market's going down, you're very likely to outperform, at least in your specific stocks. I guess the fund as a whole depends on which companies you're in, of course, but the literal 1-to-1, because you've got the call you're selling, you're going to do better than straight downside.
Yep, absolutely. You're absolutely correct there. I mean, the opportunity cost of covered calls, if the stock doubles, take NVIDIA so far this year, for example, we're going to miss out on some of that upside. We're selling away unlimited upside. There's a reason folks are paying the premium they are on these calls, and it's to have some upside potential and that exposure. So you're right. If the stocks just go ripping straight up, we'll miss out on some of that. But as far as the downside buffer, you receive that premium, which does provide a buffer if the market turns south. And just using last year as an example, the market overall was down a little over 18%. EQTIX is down about 10.25%. So those premiums that we're generating can help buffer downside. It is an equity-based portfolio. The market goes down 18%. We're not going to be up, but we're looking to at least, limit that downside and mitigate that to what extent possible.
Seems like there is sort of a quality factor bias in your biggest holdings. Does that factor into your analysis? If I were just kind of eyeball it, you got a lot of different sectors in there: healthcare. You got some biotech. I mean, you got big tech in there too. It seems like these are generally cash flow producing positive earnings businesses.
Yep, absolutely. So we do look to be pretty sector neutral relative to the S&P 500 value index. So we are going to have exposure to all the different sectors, and looking for good names and strong fundamentals is a big piece of the approach when we're looking at selecting equities for the fund. We've got, like you say, a lot of downside exposure. We have capped upside. So we're not looking for the high flyers. We're not looking for those stocks that have that volatility where they're, going for a home run. We're looking for good, stable names, good cash flow producing names, very mindful of the downside of holding the equity and having capped upside and that atypical, pattern of returns for a covered call strategy. So very value tilted.
All right, there it is. Nice take ahead of the earnings next week. Thanks a lot, Nick.